Boom! That was the third biggest rally we've seen in the S&P 500 since World War II. And it didn't come out of nowhere. If you watched last night's Market Outlook video, you had an idea a move like this was coming sooner rather than later. Markets did explode higher today after a surprise 90-day tariff pause since shockwaves throughout Wall Street. The S&P 500 surged 9%. The Nasdaq jumped nearly 12%. If you follow me on Twitter, you see that that might not be the best thing either. And one of the tweets I posted out, that Brandon Van Zee actually posted out. Crypto lit up like fireworks. Is this just a relief rally? Or are we now starting something bigger to the upside? In today's Outlook, we'll break down what's really driving this monster move, the key technical levels that could signal a breakout or a fake out. And then what today's sector rotation is telling us about the smart money moves and where they're going. So buckle up. This is not your average Wednesday. Let's dive right in. Today is Wednesday, April the 9th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, you can sign up for our daily Market Outlook email here with this window that pops up. You can also subscribe to notifications with that subscribe button up here or this bell down here at the bottom. Click on this to go to our Market Outlook live videos where I take a look at all the trades. After you see them here, we talk about managing them later during this video. Whether we should stay in, get out of them. Come down to the bottom, click that heart to like this the Market Outlook tweet. Same thing over here with the Facebook page. Again, the more you like our content on these platforms, the more they get out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now, right here while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the market forecast, the S&P 500 with the market forecast indicator here. As you can see, again, big time rally, 9.5% move to the upside, 474 points. The range today was 533 points, which is bigger than yesterday's 357, bigger than the 411, bigger than the 222 that we had, not including the gap. Like, this was a tremendous range to the upside, one of the bigger ranges that you'll see. So even though we were up 474, the range was actually a little bit bigger than that. So, and if you look, you can see we were down 10% below the 30-day moving average. We are not down 10% anymore. We are barely down 3. Now, we're still below the 2.5% mark, so we're not out of the woods here. But this short-term pattern is about as good of a short-term pattern as you can get. Right, the near-term line crossed above 40, but also on the same day it crossed 40, it crossed above 50 and 60. Remember, you got 2 days. On the first day, you got to cross 40. On the second day, you got to get up here in the reversal zone. So you got 2 days to do that. So day one, you got to get above 40. And so on day one, if you can get above 40 and one of these other lines, in this case, both of them, much, much better. Much more likely to get above 80 on the second day, which is what we need to get to on the second day here. Also, what makes it likely to get above 80 on the second day is that the momentum line got above 80 on the first day, on day one today. So very, very good move. Like, this is, I mean, you want the momentum line to be higher than the near-term line, but it's ideal if it's, like I said, up here above 80, so the near-term line will follow suit tomorrow. So again, barring a collapse tomorrow, which is unlikely, but barring a collapse here, this is a very, very good short-term pattern. The intermediate line's at 17. It's probably a day away from crossing above 20. So we'll probably have light green shading and pretty close to a bear tag here pretty soon once we get across that moving average there. So good move, good, strong. We could not have asked for a better short-term pattern. We talked about that yesterday. We talked about it would take an explosive move to get the momentum line from being as low as it was to like being where we wanted it to be. And lo and behold, that's what we got. We got an explosive move to the upside, and it was enough to get the near-term line not only just above 40, but above these other lines too. Sorry, my camera just messes up. I'm not really sure why it has issues here. So I'm just going to leave it zoomed out next time it zooms out and just get a new camera and figure out what's going on there. But so this was the day that we said could very well happen last night. We were kind of planning on some kind of move like this, maybe not to 9.5%, but a move like this to occur, if not over a single day, potentially over like multiple days. Well, we got it in a single day today. So very, very good rally. And like I said, the short-term sentiment here sets us up for, what may be more than that, more than just today's move. Obviously, your Nasdaq 100 was up over 12% today. It's only 2% below the moving average now. Also got the exact same pattern, crossing above 40, 50, and 60 on the near-term line, crossing above 80 on the momentum line. Again, about as good of a short-term pattern as you could possibly get there. Intermediate line is rising, but still below the 20th percentile. Maybe for just one more day is probably all we're going to get on that. The Dow Jones Industrial Average up almost 8%. Again, above 80 on the momentum line, above 60 on the near-term line after being below 40 on both of them yesterday. Intermediate line is still below 20, but it's rising and it's maybe a day away. If you remember, it's got to get above the market sentiment line. So just getting above 20 is not enough. It's got to get above market sentiment to really change the trend to the upside. But it doesn't mean that, again, we can't be this like we talked about yesterday. Yesterday, we could start to be a little bit bullish because we knew that we were in the process of forming a low point. Now today, and so you can take advantage of it like a day like today. But now we can start to nibble a little bit more. The Russell 2000 wasn't as bad. It got an engulfing pattern, right? It actually engulfed the last three candle bodies that we had, filling in the gap there that we had on April the 4th, the day we had the cluster. We are still 5% below the moving average. So remember, the Russell 2000 is a much more bearish condition than the S&P. It had already been in a correction before the S&P even started its pullback, or at least was in its pullback stage. But again, momentum line crossing above 80. It was the only one to get above 90. So 8.66%. It wasn't as big as the Nasdaq, but big enough and closing close enough to the high of the day that near-term momentum line jumped higher for the Russell than any of the other indexes. So even if the near-term line didn't quite get above 60, still is likely to get above 80 because it at least crossed 52, right? So 40 and 50. And then the momentum line being as high as it is at extreme highs, anything above 90 is extreme to the upside, then that sets us up for the possibility, the likelihood that the near-term line follows suit and gets up there tomorrow as well. Again, barring a significant drop tomorrow, that obviously is very unlikely to happen. Let's take a look at what it did to that Heikin-Ashi candle on the weekly chart. It's still a lower Heikin-Ashi low. It's still you still got a lower low. But look at the body. Like the body here has really, remember how yesterday it was like down quite a bit? Well, it's back up now. It's actually a smaller body this week, slightly, than last week's body was. And if you look at, again, like next week's body is going to open up at 53.56. We're trading at 54.56 right now. So we're actually trading above that. So again, depending upon how we close, we got 2 more days left. We could very well set up a doji pattern, so something like this. Now, that doesn't mean necessarily that we're out of the woods, because you can see when we're in correction, you tend to get this, right? You get these doji patterns, these reversal patterns. Sometimes they reverse briefly. Sometimes they don't reverse at all. In this case, it reversed for a week and dropped. In this case, we had multiples, and we reversed for 4 or 5 weeks before we dropped. Remember, corrections can be multi-leg. This was a multi-leg correction here, 2 legs. And this could very well be that again. So it doesn't necessarily mean that we're out of the woods if we don't have to reverse, but at least it means that next week's candle most likely won't be another bearish one. Like I said, at worst it will be a transition candle that might not be a reversal, but at least it's not still bear. We might buy ourselves at least a few weeks before any kind of bearishness persists. Obviously, taking a look at the 3 green arrows, you can see it kind of goes to show how bearish we were, that this move didn't even produce a single green arrow. Obviously, we're still below the moving averages, but the stochastics is the one that's probably the closest to getting arrows, and they all turned up, but they're still all below that 25th percentile in this case. And that MACD, the MACD actually jumped up on the Nasdaq and the S&P quite a bit, suggesting that we could, go positive in another day or two on the MACD and get that green arrow there. If I take a look at the 2-line version, as big of a move as that was, at first, for the longest time, we were just above the 8 day, excuse me. Look at this. We crossed above the 8 and the 17 day. We filled in the gap from April the 4th. We still got that gap there from April the 3rd. Filling in that gap essentially would get us to the 30 day and the point of control. And there's going to be some significant resistance here. Some very significant. So don't think that, hey, we're out of the woods, we're breaking up. The reason why we jumped up so much is for the reasons why we talked about last night. The extremes were there. We were in the process of a low, and the further down we were, the more likely we are to bounce up pretty quickly. Again, I did not think we would go up 9.5% or SPY 10.5% in a day, right? That's a big, big move. But that kind of move could have been really easy to do over the course of 2 or 3 days. The fact that it occurred over one doesn't necessarily mean that's any better. In fact, as you see on my Twitter feed and what Brandon shared, it's actually probably worse that it occurred in a single day because it makes it likely that we can't build on it. How big of a move that is, and especially, like I said, getting to resistance, going from extremely oversold to the extreme to being within shouting distance of resistance in a single day, makes it hard to really build up the momentum to burst through that resistance there. And stochastic still below its moving average, though turning up. MACD below its moving average. Remember, it was coming off an extreme low, so it's going to bounce up here pretty quickly as well. Looking at some of these other, and you can see all the volume down there. Looking at some of these other oscillators, look at that big jump. Remember, we were below 10 yesterday on the positive indicator. Well, we're still below 20, and we're still above 25, and for that matter, above 30 on the negative indicator. But clear reversal there on the DMI. Looking at the RSI and the CCI, again, we're not at, the red box is still here. It was a good jump to the upside, but we still the box is still red. It doesn't stop being red until you're above 50, and it doesn't turn green until that break above 50 also gets above 60. And so, obviously that's not the case because we're still below 50, and we're actually still below 0 in the CCI, but it was coming off of an extreme low that it had below 300 and still, closer to minus 200 these last couple of days. If I take a look at the Ichimoku cloud, we are above the blue line, which generally means that the bearish trend that you're on ends. It still hasn't ended. It's still very mature, but give it another day or two above this blue line and it will end. The rate of change is still negative. It won't get positive here anytime soon unless we, again, break up. We'd have to break all the way up here, and we're still way below the cloud. The cloud has turned pink, so remember, we're supposed to be above the cloud when it turns pink, and we're way below it. In fact, we were so extreme that it makes this kind of move so likely. Again, like kind of what we talked about yesterday. And then finally, looking at the Bollinger Bands, remember how we were way outside the bands? Well, now we're at the midpoint of the bandwidth. We've been here before, so that's not new. It just didn't happen in a day, but we've been to the midpoint of this range before. You can see the momentum is still negative, even if it has turned up closer to 0. It's still negative. We were so far below the Keltner channel these last few days. Now not so much, right? We're way outside the Keltner channel. So kind of what I talked about with our market scholars is, as big of a move as this is, and with earnings season coming up, I really wouldn't be surprised if before we get above these moving averages, right? Let's say that this correction will, because remember, a correction gets us down to the 200-week moving average. I still think we reach kind of like this, where it's a multi-leg. I think we end up doing that again, where we retest this low, and depending upon where it's at by the time we get there, we retest this low, but we fall a lot slower than we fell this first time to get here the first time. And it might be kind of more of a negative reaction to earnings that propels it back down to the downside, just at a much, much slower pace. But that's kind of how I view, I think we still will get, an opportunity for some upside into resistance into this area. I think it will have a hard time breaking through this area here. and we'll see. But I don't think necessarily that this will be a correction failure. I actually still think that we'll be in correction mode and retesting these lows and looking at that 200-week moving average, and then we'll, so that, remember, corrections take months. Like it takes a lot longer than just a few days below the 200-day moving average. So we have an opportunity for some more downside here, obviously just at a much slower pace than what we saw over essentially the past 5 sessions to the downside. If I take a look, you saw the range and the volume here. Sorry, wrong one. We're extreme again. This is even a bigger range of what we had. The volume at 240 million. I told you yesterday, once we rally, the moves will generally be bigger, and so it will actually make the ATR keep going up, and it did. It's above 3.5 now. I don't think we'll probably drop way back now, way down. The ATR is going to be close, is up to 18, almost 19. So I don't think we'll get big 40, 30, 50 point moves anymore. And eventually that normalized ATR will peak, but this is such a high number. And the VIX, remember, the VIX was at 50, and it was such a high number. But look at the big drop the VIX had. I mean, that's a huge drop in the VIX. The VVIX dropped back down, still very high at 142, but it dropped down. The VIX relative to the VIX 3M dropped down, still above the 105% mark. So still very high, but filling in that gap. So it's still, it's way off of the peak of where we were. If you look at on the daily chart here, I mean, look at that drop. Where we were at yesterday. 126 and 127 the day before that. So 2 days in a row, really 3 days. And well, I don't think this one finished up above. Sorry, my computer is slow. I don't think. Gosh, it's really slow. Here we go. I'll give it 1 second. Oh man, this is so annoying. All right, so let's see, we were almost to 125, but 3 days essentially around 125, which is very high level, but dropping down significantly, and as we get closer to 100%, dropping back below this 105 and 100% levels, very bullish for equity, so bearish for volatility when that happens. We didn't look at the intraday range here. We filled in this gap. We talked about that. We did, we had a higher high and a higher low, and closed above yesterday's high, as big of a move as that was. If you look at where we are in the range here, we are back in the bullish territory. We were not in bullish territory for either one of these moves, and now we are back in above the 60th percentile. So that's a very good sign for the markets if we can stay up here. Ideally, get up to above 80 and 90, right? That would be your ideal scenario, which essentially would mean that we have to fill in this gap and get above this resistance and get back up here. So again, we've made so much of a move so fast all in one day that it doesn't give us time to build into this. It's like, oh, we're already there. We're already at resistance. So like I said, that might actually make it more likely we don't keep going up. And that's the kind of a concern that I have for the size and scope. I mean, it would have been better to spread this out over a few days so that we can build into that resistance instead of just all at once. Getting there. It might suggest that there's, again, like I said, another test of these lows to come, just maybe not as fast as what we saw from the close on April 2nd to the open on April the 7th. So let's see here, and then we saw the VIX. Let's go now into what's driving the price action for today. So let's go to the asset class comparison chart. You can see the big jump. Look at that jump in gold. Let's zoom in on just today and compare that move on gold to equities move. And of course, again, big time move. But gold started the day very strong until the news announcement came that the tariffs were paused. And then, stocks which were bullish already, and they had, they were down overnight when the tariffs with China hit at midnight Eastern. They started to rebound in the morning. We talked about that last because I was doing the video when that came out last night. But stocks didn't just rocket it up higher. Like I said, the Q's up almost 12%. Nasdaq 100, the actual index, was over 12%. The S&P there at 10. developed markets, emerging markets, underperforming, but still really good returns. Gold held its gains for most of the day. The dollar was relatively flat, and bonds started the day down, which, again, that's the whole idea that, bond yields are rising so much. In fact, they had gapped up overnight big time. The high was 4.47. I saw some people talking about a 4.6%. Remember that there is a limit to bond yields, so that there's a ceiling, and that's the Fed funds rate, 4.25%, 4.5%. So we can trade in that range, and obviously, still, even with this rally, still in that range. Really, we start worrying about a trend to the upside for yields if we were to get above 4.5%. That'd be kind of like a breakout. There's a resistance there that might not be on the chart. But it's there because of the Fed funds rate, right? So there's a resistance at 4.5 that if we were to break through, that would be a sign, obviously not of economic growth expectations, but it would be a sign that inflation expectations are rising and moving up higher, and that there are more selling of bonds going on. Obviously, they can be offset by the buying. So we did gap up, big gap to the upside, but we ended up falling from the open. And I think we'll probably fill in that gap. Again, the bottom of the gap is at the bottom of the range, 4.25%. So that wouldn't be necessarily, that's just noise. That kind of move would just be noise. But the drop in yields is coincident right now with equities. So a jump in yields, even if it's temporary, is going to provide some positivity for stocks. Here's the correlation of yields to stocks. And you can see it's been positive. And it hasn't been for the last, during this inflationary environment. But since we've been dropping and we are in a deflationary mode, then it's been a lot more of a positive correlation between yields and equities. In fact, when you look at the 3-month correlation instead of just the 2-week, you can see it's pretty strongly positive, that correlation there. So a jump in yields, considering the market as bullish as it is, a jump in yields may not necessarily be so prolonged. And that, again, could be another sign that the S&P might be this move, which would have been better to build multiple days into this, may have gone up too far, too fast, too soon, right? Too far and too fast there. Let's take a look at the dollar index and see how it's doing today, because that's been a pretty big driver. But remember, it's on the asset class comparison chart, it was actually pretty flat relative to all the other asset classes. And you can kind of see it's a big range. And the dollar appears to be setting in a low point there too, a divergent low point no less, because it would be a higher low on these indicators versus the last low that we had, which was we've been getting lower lows on the index itself. So there is a possibility for some bullishness in the dollar there. And if you look at that correlation that the dollar has had with the S&P 500, you can see it's been positive. So that would be a good sign for equities. If yields can hold up and the dollar goes back up a little bit, their recent correlations would suggest that'd be a positive thing. You can see it's not as positive on a longer term basis with the dollar, but pretty positive, 78%. That's not normal, but we'll take it right now. And so a strength in the dollar here, considering the tariff fight that's going on. If we get some positive news in that front, then the strengthening dollar would actually be very beneficial for equities, considering their correlation right now. The big sign that things were kind of going south, not just from an investor sentiment standpoint, but just from a global, economic standpoint, was the fact that crude oil had just dropped so much. But it itself rallied 5%, a little bit of an engulfing pattern, long lower shadow. Again, it can make a temporary run up towards these moving averages, but there's a lot of resistance at those moving averages. So it's not impossible to get through that resistance. It just will, as much of a move as it will take just to get to it, it's going to need as much energy or more to break through it, which is unlikely. So we'll bank on some strength here in the the next so many days to maybe a couple weeks. But after that, it's going to be we're going to be watching for any kind of failures in risk appetite, no matter what the asset class that is describing it, even if it's Bitcoin, right? Because Bitcoin would be the upper end of risk appetite. I mean, it wasn't as so extreme to the downside, but as good of a rally as we have, we're still below moving averages, and we haven't rebounded. The stochastic and MACD are not at bullish levels, so it's great. One day is great, especially here on Bitcoin. It's not so extreme. The downside wasn't extreme, and the upside isn't extreme. But it's also, as much as it's not very extreme, it's also not very strong enough to change, right? To expect a change, considering that when you get below moving averages, short-term moving averages to a degree, then you're going to rebound back to them, right? To the short-term averages, because that's what they are. They are the average, and we return to the mean, make a return to mean in the short term. We always do in the long term too. It just takes a lot longer. In the short term, it can happen like we saw, just in a day or two. Not usually in just one day, but usually if just a few days, we can get right back to the mean in some of these shorter term moving averages. All right, let's take a look at the breadth indicators. Much better breadth. That's another good sign, is this was a very broad rally. Look at we went from being below -15, now only -14. That's a good sign. Here, let me bring this over here. There you can see it ordering my new camera. Let's take a look at the number of stocks above their 50-day moving average. Remember how that was extreme? Well, it's still below 100, so it's still below the 20% mark, and now we're anywhere clear. It's not clear to close to its moving average, nor getting out of bearish territory. But still, we're not as extreme as we were. In fact, this big spike that we had is already back below 2. We were up to 3, and now we're already back below 2. So that's what we want to see. And the MACD here is popping. We want to see this line come back down, because that usually leads to bullish trends. So that the breadth is actually looking much better. The number of new lows is still a little too high. Just not at least it's not above 1,000. The net new highs and lows are still negative, but not as extreme as they were, and bouncing back up. So all those extremes that we saw that we talked about the last couple of videos, talking about, okay, we're set up for a bounce. We're setting the low, even if we might go a little bit lower. That doesn't matter. We were setting the low so we can start to look for some bullish risk appetite trades. And now it looks like now we're not so extreme. But even though we're not so extreme, we are still bearish enough that there is still some upside. I still think it's limited. The upside that we have is limited because of how much we've already used up. As I said, the zigzag, the expectation was that the zigzag here would get a double-digit number in it, in the green box. Well, in one day, we almost have a double-digit number. We're already 9.5%. And to get to those resistance levels, it's like a 12-13% run, and that's it. So we're most of the way there. This is all we're going to get to, is this, and we're most of the way there. We're going to get that double-digit tag, and then it'll be a matter of whether or not, like the last correction, we get a second leg lower. See, we got a double-digit tag there, 11%, but then we had we had that pullback, the failed bounce. We got that first leg lower. It's a big, relatively big drop, but then we rebounded. Oh, great! But then, and that was pretty fast too. It didn't take a day, but it was, we were up pretty much every day. 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 11 days to the upside, up to 11% gain. But then it failed, and we got the next leg lower on the correction. We had some pretty good rallies. We had a 17% rally there, but that one failed, and we got to a new leg lower, and finally hit that 200-week moving average there. So, this is the kind of, these are the kind of bear tags that I'm expecting we're going to get right now, and I expect we'll get at least one more leg lower, another red tag here that will probably be slightly lower, or at least around equal levels as this one, before we finally make our run up to our correction bounce, right? Stage 4. of our bear market process. Let's take a look at the sector rotation. Look at that, 3-month returns, much better. Zooming in on just today. Look at that big 13% gain in technology, 11% gain in consumer discretionary, 9% on the S&P. Everything else kind of matched. The safety sectors were up, right? Remember, they were doing so good, but I was going to go on Charles Payne this morning. Charles Payne had asked me, one of his producers had asked me this morning if I could step in early this morning. And I was going to talk about, like, you know, because they were asking me, like, what sectors to follow and which stocks. And I was going to say, the stocks you want to buy when we get this rally, and I didn't know it would be this afternoon, but it was going to be soon, because based on what I've talked to you about in the last couple of days, he asked for stock picks and asked for areas of the market to look at, and I was going to tell him, same stocks that led the way to the downside are going to be the ones that lead to the upside. The only two sectors that have been underperforming the market during this whole decline were XOK and XLY. The only two sectors that outperform the market today, XOK and XLY. That's, this is not rocket science, right? I mean, we even said this in prior videos that, these are going to be the areas that bounce up the most, and boy, howdy did they bounce up the most here today. All right, well, that brings us to our trade idea of the day. Let's bring up the market forecast chart here. It's actually on a consumer discretionary name, and that's Ross Stores. Ross Stores bounced up, got a big bear tag, well above the moving average, 5% above the moving average. Same kind of good bullish near-term pattern. The intermediate line's already above 40, so it hasn't been as bearish. It's already been kind of rebounding a little bit here before we got these big volatility days. So, in fact, we got a bear tag last week. This is our second bear tag. If you look at the crossover chart, the weekly chart, you can see that, again, we got some transition candles. The difference, though, is we got a green arrow this week's, and this week's is a little bit more bullish of a transition candle. So some bullish patterns there. Obviously, we have, with that bear tag, we have 3 green arrows on the stock now. Well, 2. The stochastics hasn't turned up yet, but we're close to getting 3 green arrows. As you saw, we are above the 30-day moving average, but you see we're also really darn close to not, we're above the 50-day too. We're right there at the bottom of the value area. The point of control is at the bottom of the value area. So you have multiple volume resistance levels right where we're at. These old lows happen to be in this area as well. So you got some pretty significant resistance. And some of these oscillators look good, but they don't look that great. Like, we're not, we're above 20 on the positive and we're above the negative, but the negative's barely below 20. The RSI and the CCI are, relatively bullish, not like breakout levels, but, bullish kind of enough. You look at the Ichimoku cloud, we do not have a bullish trend. We just basically ended the bearish trend. We're still below the cloud. The rate of change is only slightly positive there. And then you look at the Bollinger Bands and the Keltner channels, and we did get above the upper band. We didn't finish above the upper Keltner channel. The bands are inside the Keltner channels. There's some weak momentum there. But because of that pretty relatively close resistance, what I decided to do was, here, let's go to over here. I decided to do a iron condor spread. So selling what would this be? It was kind of closer to 40, low 40s on the delta, because remember I got the resistance on the upside, so I didn't mind being a little bit closer on the bear call side of things, and I went to the 30 delta here on the bull put spread. So as you saw, there's my iron condor, and because of the relatively wide spreads, we got a pretty decent return. There's a lot of risk into this, so I ended up because it's more risky, I only put half the risk into the normal for iron condor, but I ended up getting like $1,000 reward. So it's a 2-to-1 reward to risk ratio, as long as the stock stays up here on the upside, stays below its 200-day moving average, and then stays within the range of these lows on the downside. So, which is, what we're trying to do here is just take advantage of the fact that we had a big move up, and now we'll probably start to slow down on the size of the moves. I think the market in general will start to slow down. The size of the moves that from what we've had over the past few days start getting a lot smaller, and ideally for Ross, stay in this range where I can get a pretty decent reward out of it. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.